Rising bond yields have recently been triggering rotations within equities and underperformance in emerging markets. But how far can yields rise?
Well, in determining the danger that higher bond yields pose for risk assets, we've got to firstly determine what's driving the bond yields higher. And there are several elements here. One is this could well be bond yields responding to anticipation of a pickup in nominal GDP growth, the reflation narrative. Bearing in mind longer term, nominal yields relate to nominal GDP plus or minus some sort of term premium account. Now, if that is the case, that's quite supportive for risk assets. That's telling us that we can anticipate a good recovery in operating leverage, in profitability, and that will then be us going back to a world of the negative correlation. What's good for equities is bad for bonds and vice versa. Of course, if the move in the bond market is all about a pickup in inflationary expectations, and bearing in mind the last 3 months, the key driver of the nominal yield has been break-even inflation moving higher, then if this is telling us there's a sustainable move in inflation, that's not so good for risk assets, simply because, as we saw in 2011, the markets could work out that that's got serious implications for corporate margins and real disposable income. And the other element is just really one of whether this is all about the bond vigilantes getting concerned about the central banks being not appropriately positioned in terms of their accommodation. And as we saw in 2013, when you had the taper tantrum, the bond market moved ahead of forcing the central bank, the Federal Reserve, to taper its balance sheet. And this is, again, not so positive for risk assets. If this were to occur, then we're going to have the whole conjecture about whether there's a risk of what we call policy mistakes being injected into markets. Where could bond markets go? I think we've got to take a long-term view on this and understand that bond markets and yields have been in a 40-year decline. They were in the high teens in 1980. They fell to sub 1% in the US last year. But if we look more recently, I think what we saw was an overreaction to the downside last year in reaction to the COVID deflationary risk, and there's a bit of mean reversion. I think the markets are naturally mean reverting back to the levels they were prior to the COVID shock of roughly 1.75% or 2%. So it's more the manner of which they go. Going back to there over gradually in an orderly manner wouldn't spook markets too much, I don't think. If they go in one very sudden jump, that becomes a sign of more disorderly functioning.
Rotations from growth to value stocks has been a key element of recent weeks. But can this momentum continue?
The rotation element is a very interesting one here. And I think, again, we've got to understand there are possibly 3 drivers of that. The first goes back to the natural inference. If you're getting more growth expectation being built into markets, that people are looking for sectors that will participate in that economic recovery, both cyclicals, but clearly financials would benefit from that type of economic move as well. I think you've also got the clear inference from a steepening of yield curves and the pickup in bond yields that's positive for net margins in the banking sector. That's the second positive. But the third one, I think, is the more significant one, which is a rising bond yield, rising discount rate puts a lot of pressure on the highly valued quality stocks. These growth stocks that have been the star performers for the last 4 or 5 years in the markets are now bumping up against valuation headwinds courtesy of this pickup in the discount rate. So the bond market is starting to give very strong signaling about the need to rotate out of these quality stocks into the value stocks. And financials and banks are the key way of playing that type of factor rotation.
Over the last decade, US equities have generally outperformed other major benchmarks. But can that leadership now come under sustained pressure?
This is the $64 billion question, is in terms of leadership shift, is how significant will this be? If we do start to see a really sustained move out of the US technology sector, given the US tech dominance of both the US market, but also being the contributor, the driver of US outperformance, then this could create quite a big sort of feedback loop. I think the key thing to watch here will be whether you see this reflected in the US dollar. Asset allocators are very attuned to this. In the fourth quarter, we saw people playing the reflation trade as being dollar negative, and that was all off of growth differentials. But at the moment, what we're starting to see is people looking more at interest rate differentials coming back in, and that's adding a bit of support to the dollar. But the DXY dollar index was hitting key support levels, and that was very germane to whether this becomes a proper capital flow story out of the States. If the dollar were to weaken further from here, then I think you would see asset allocators looking to most probably move money out of the US into non-US markets. I don't think we've seen that yet, but I think that's clearly going to be quite a key thing to focus on over the coming weeks.
The next FOMC is on the 17th of March. So far, the Fed have been relatively confident about the policy tools at their disposal.
Jay Powell is doing all he can to tell people we're not going to be panicked here, we're not going to be spooked, we're going to maintain the view of being patient. I think that is the correct stance. They're well aware of the headwinds that the US and other labour markets around the world are facing over the coming months, and that yes, we are seeing some pickup in inflation, but it is most probably short-term cost push inflation that won't be permanent. And I think then they're going to be fairly relaxed to this higher bond yield. As I said, I think the thing that will create the problems is if it's seen as a disorderly move in the bond yield. If it's too rapid, too sudden, the vigilantes give it too much of a push, and the accusation is then that the Fed are behind the curve. That's when it becomes problematic. But I actually think they've got lots of firepower in terms of reinvigorating Operation Twist, going to formal yield curve management as a way of containing that. And I don't think, as I said, the Fed would worry if the bond yield went back to the levels it was at the start of last year, 1.75% to 2%.
The Fed will be watching closely. Markets are resilient to relatively gradual changes in bond yields and the dollar. But if the dollar and yields start to move too quickly, the Fed may be forced to increase its QE operation or initiate yield curve control to cap yields. If they do that, then risk assets and inflation expectations should have a lot further to run.